Good afternoon, dear traders. The next block is statistical publications, news, and external background. Has it happened to you that you open leading television channels, hear that the market is positive, immediately buy, and the market suddenly turns? Or on the contrary, everyone shouts with one voice that everything is bad, but the market suddenly begins to buy back at high volumes? I think so. I was no exception. It seemed to me that if an authoritative publication says that the market is good, then why not buy it? Conversely, why try to your luck if they say that everything is bad? I remember one phrase by J.P. Morgan, that once a shoe shiner becomes interested in stocks, he must leave the stock market immediately. And you know, his phrase remains relevant to these days. You need to think exclusively with your own head and implement your strategy, your vision of the market. Of course, the strategy should contain both mathematical and ideological advantages, and we talked about this in previous webinars. Therefore, no matter what reputable publications say, you must fully rely and trust your own analysis. And if your strategy says that purchases are interesting, then you are primarily interested in your analysis. Well, what if you are wrong? Then there is no one to blame, and here you are just working with a restriction on risk. For example, a stop-loss order, as an admission that you are wrong. It is worth remembering that losses are part of the trading system. Remember the math block? It is not a single trade that determines the result, but the totally that express the mathematics of your trading system. Let me remind you again the percentage of positive trades, the depth of drawdown and risk, and the potential for risk that you take away in each trade. In this webinar, we will not dwell on each statistical element in detail. It will take hours of time, and there is enough information on the internet. Well, if suddenly you are interested in each of them, then we will hold a separate webinar on this topic. In this webinar, I want to focus on the main elements behind which the eyes of trading public are divided. First of all, it should be noted that the shorter the time range for holding the position, the less the influence of fundamental factors, but only the reaction to the external background of the current day and the reaction to the published statistics. For an intraday trader, it is not the dynamics of statistics that is much more important, but how the market reacts at the moment. For example, does the market succumb to a panic on a negative publication on GDP, or is holding confidently, creating additional favorable probabilities for buying on a small correction? Or on the contrary, the market reacts weakly to the publication on positive news, and you see a clear resistance above which the market cannot step, and this is already prerequisite for becoming short. So, if we are trade in a long-term or medium-term framework, then statistics are important in dynamic. That is, where the market is looking and what expectations may be. It is not only the statistics themselves that are important, but also the accompanying factors. ISM manufacturing as an indicator that is ahead of GDP data. We can say that after the publication of ISM, GDP expectations are already in price. For example, let's look at figure 1. We see an increase in the ISM manufacturing index, and it closely correlates with GDP. This correlation is over 60%. What do we see from ISM here? We see that it says then the next publication on GDP will be with growth. But we also see that the indicator reached 60, where the end of the cycle occurs, and quite possibly the end of the cycle will also happen this time. Of course, this will not happen all at once, and the accompanying factors must be taken into account. At this point, the allocation of additional money to the economy is discussed, which keeps the market from falling at the end of this cycle. But nevertheless, according to the graph you see now, that there is a reaction, downside reaction. If we switch to an intraday chart, a minute chart, then now you see that it does not matter what happens on the foundation, and it is intraday that has its own reaction, allowing intraday traders to trade both long and short, depending on the situation and the market reaction. Additionally, it is also useful to look at construction data, durable goods orders, or personal expenses, or consumer income to learn about the state of the economy by sector. And all this is part of the GDP, and in one way or another is of interest for understanding the general picture, and especially if you are looking for certain ideas on stocks, weak or strong sectors. When the economy is growing and without problems, the reaction to the unemployment figures is likely to be restrained, or the market will ignore it. Since the difference between the previous values and expectations is not significant. But in cases of problems in the market, be it crisis or pandemic, the unemployment figures are of increased interest. This is logical. Imagine what would happen if, without financial and social assistance, half of the population was left without work. There will be a riot and possibly a revolution. Therefore, the authorities of any country closely monitor the level of unemployment. The employed are primarily people who received income and are able to spend money. And cash expenditure, again, are a component of GDP. You see how everything is interconnected. And here the claims for unemployment benefit are also an ISM leading indicator that allows you to estimate what the next report of the unemployment rate will be. We see that a few numbers with a decrease in initial jobless claims leads to a decrease in the unemployment rate from 14% at the highest of the pandemic to 6.7%. But this is far from ideal. And here we can again build assumptions that the regulator will intend to continue to stimulate the market until the level drops to its lows before the pandemic. But of course, almost any trader, and especially an investor, will be interested in the question, how long can they pump up the market and create the illusion of well-being? I must say right away that in the modern world, and it has always been so, politics and economics go hand in hand, and so that they do not talk about the free market and the invisible hand of Adam Smith. It should be understood that by the will of the natural life of the cycles, none of the politicians wants to fail. Let it be an others who follows him. These will be their problems. Alas, these are realities. But we see here that as a result, while inflations inflation allows, it is possible to pump more and more money into the market, spurring growth and luring the population of any country in the race of prosperity. But so far, inflation allows. Let's look at this picture. Take a look here. We see in a longer term segment, which is published by the Michigan Institute, that inflation may well accelerate to 10% and quite higher, since there have not been such volumes of money injection in history. The first hints of the inflation will prompt the regulator to immediately raise interest rates in order to prevent hyperinflation and the fiasco of the entire economic system. The credit bubble will begin to burst, the cycle will end, and the stock market will immediately rush into a falling peak. That is why inflation is given special importance and attention in the analysis. This is exactly the incentive ceiling that could suddenly rise in the face of a bull market. But as I said, it will happen in time, not in the moment. Therefore, the difference in trading styles is essential for an investment manager and a trader in long-term positions. And for intraday trader who is interested in the market reaction here and now. So I hope that this short webinar without details on each indicator will be much more important and understandable for you than listening to a ton of information about anything. I wish you professional approach and development, and soon we will meet on the 6th video, which is usually the most interesting for traders. There are entry points and placing stop loss orders. Good afternoon, dear traders. Today we finally got the most important block. This is the block of mathematics and statistics. Yes, you heard right. This is the most important block. Not entry points, not even a choice of instruments, but a mathematical block. The fact is that without mathematics and statistics, all attempts to establish a profitable system will be negligible. You will simply be doomed to run in cycles without knowing your strengths and weaknesses. You will have no chance of optimization. Of course, I understand that this is the most routine work, which may not be to everyone's liking. But this is what professional trading is all about. Experience, skill, and knowledge, and ability to work with your own numbers. Statisticians usually say that for successful and comprehensive analysis, statistics of at least 200 transactions are needed. In reality, 50 will be enough for you for a more or less complete analysis. That is why traders often start out loud with intraday trading. For medium and long-term deals, a very long stage of accumulating the cherished 50 deals will be required. Of course, in order not to waste time in vain, it doesn't just have to be some crazy deals without ideas. You must think over your approach competently. Answer the question, what is the advantage and whether it is. Lay down an idea of each transaction. It can be trading of consolidations, levels, volatility reports, but the idea is required. Then the stage of statistics accumulation will be reasonable. You will receive information for a comprehensive analysis and optimization for 50 transactions. Of course, when you are at the initial stage, mistakes will be made and there will be a lot of them. But analyzing each completed transaction, you will be able to correct, understand what was done wrong. I show the first picture. That is the screen and first picture here. Okay, as a rule, an wise trader cannot get out even on 15–20% of positive trades. That is, falling into the grip of volatility, market noise, in an attempt to place a short stop order constantly receives losses. But these are already the skills of a competent choice of an instrument and an entry point. You see here, here, or if you trade in this range. Second picture. That is, sometimes it is necessary to show restraint and discipline. The behavior will not become readable. This is the real deal with technological index. And you see, discipline needed here until you can read this situation. Next, work with a break-even point and guide the instrument. I can transfer stop-loss order into a non-profitable level. And finally, picture 4, in this case, a profit taken at risk of 9-1. That is, if you risk $100, you get $900 profit. There are situations when the instrument holds the level of cent to cent. This is S&P 500, and you can see that S&P 500 holds this level point to point, cent to cent. But it depends on each specific case, and we will talk in more detail at the 6th webinar on entry points. Now let's look at this picture. What does the percentage of positive transactions mean? For example, you have made 10 deals. Of these, 3 are profitable and 3 are unprofitable. Your percentage of a positive trade is 30%. Let's add it to the table. Here you see 30%. The next point is the risk per trade. For beginners, in particular, I recommend using the lowest possible risk and raising the risk only by accumulating profits. Let's put 0.25% here. If you have less capital, this number can reach 0.5% or even 1%. That is, for $10,000 of your deposit, your risk is 25 per trade, so 0.25%. The next point will come to you from statistics, and it is very important to understand it. This is the number of losing trades in a row. Imagine that you are trading with 5% risk per trade, not 0.25, but 5% risk per trade, and you have 10 losing trades. There is no half of your deposit here in such situation with 5% risk when you have drawdown with 7%. Therefore, I highly recommend starting with minimal risks. In this case, with a risk 0.25% and 7 losing trades in a row, your drawdown will be 2%. The next very important parameter is the ratio of taking average profit to average loss. The example showed about what 9 to 1 in my deal that I showed for you. This parameter is close to the percentage of positive trades. As you can see, with a risk potential of 3 to 1, you can count on 3% minus commissions, of course, per month and annual return. Now let's see what happens if a newable makes a lot of losing and his percentage of positive trades is catastrophically low, say 15% here. You see that after deducting commissions, you almost inevitably lose your deposit in a year. Okay. You see the difference here. 3, 7. Okay. Now let's look at this picture. But already with ratio 7 to 1, your approach has the right to life with such a low rate of positive transactions. You see, even with 15%, but with profit-loss ratio, your system is working. Okay, you can immediately think of why not say then 20 to 1 profit in relation to risk and profitability source to 387% per annum. You need to understand that each instrument has its own average volatility, and an attempt to take a higher potential can automatically face an even lower percentage of positive trades. Such wide range movements happen only in 5% of all cases, and you still need to get in these 5% cases. So, you see here 20 to 1, but in the best cases, 5%, and you need to catch this 5%. So that is an attempt to take 20 to 1. At best, you can result in 5% of positive trades, but it will rather be lower. Then another idea comes to mind. Since the market noise is killing short stop-loss orders, why not give me a higher stop-loss distance and take a higher percentage of positive trades? You have set 50% of positive trades for yourself, and the potential is 3 to 1, and you are already happily expecting a positive result. You can Google it. It's a lot of recommendation to set 3 to 1, and that you simply can achieve 50% of positive transactions. But you know, in practice, if the instrument is under pressure, then it will reach the distant stop, and your percentage of positive trades, again, if unexperienced, will be reduced below 20%. Thus, new hopes and new disappointments suggest that a trading strategy is not working, or the market is extremely noisy to trade, but there is no main reason. This is experience, skill, and ability to work with mathematics. In conclusion, I will say that trading is like a sport that requires skills and optimization of each of its actions. Only a trained trader who studied his strengths and weaknesses is able to achieve results. Remember from the previous webinar which guys you are trying to gnaw off your profit on the market. Good luck in your development, and we will soon meet at the next webinar, which also does not pass by the views of traders. This is news, statistics, and what to look for. Thank you, and see you soon.